Today I've been chatting about dividend investing and how we do global equity income at Threadneedle, and also in this current environment where interest rates are rising, how that impacts our views on dividend investing. So for us, with the dividend investing, what we're looking for are companies that are good capital allocators. So we sort of see dividends as a sign of investment quality. So we're looking for companies that have got healthy cash flow and are putting that cash flow back into the business to generate growth and also to give money back to shareholders. I think when you've got that capital allocation discipline, it means that companies are making sure that they are investing only in high return investments and not doing malinvestment in low return projects. I think it's been well received. I think I've had a lot of questions today. I think mainly focusing around about sort of our 4% dividend yield hurdle. I think it's quite a differentiator among funds within the market. And the reason sort of we have the 4% dividend yield is that we think that a high dividend yield approach works over the long term, and therefore we're looking for quality income. We're looking for a 4% dividend yield with income growth of over 5% and a balance sheet that is in a good shape. So that's where most of the questions have come, asking where the 4% comes from. That is where we see a viable opportunity set to make a balanced and diversified portfolio by sector and stock type. So at the moment, within our universe with $1 billion market cap and over 4% dividend yield, that is 1,200 stocks. And we feel we can get a portfolio of 75 to 95 stocks out of that opportunity set, which matches the criteria that we're looking for and can deliver good performance to investors over the long term. I think since the QE taper was announced, I think there's been two types of stocks. One, you've got the bond proxies, which we see as high dividend yield stocks that have got modest growth potential. And those stocks have underperformed for the first couple of months and continued underperforming. Whereas those stocks that have got income and have got a decent growth potential, those stocks underperformed for the first couple of months, but they've actually recovered since the QE taper framework was announced by Ben Bernanke in sort of Q2 2013. So I think going forward, we think that you've got to have both income and growth within your portfolio. Having just having a high dividend yield is not enough. I think you've got to have that growth within it that turns it into quality income, and it's quality income that is actually going to outperform in a rising interest rate environment.